You're about to hear my conversation with Caroline Edwards, Senior Client Portfolio Manager with Putnam Investments. Today, we're going to talk about the newly launched Mackenzie U.S. Value Fund. We'll get into the details of the team's investment philosophy, and Caroline will also share specific examples that bring the team's buy and sell discipline to life.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation.
Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction in Mackenzie Private Wealth. Today, I'm joined by Caroline Edwards, Senior Client Portfolio Manager who is focused on Putnam's value strategies. Caroline, thank you for joining the podcast today.
Thanks so much for having me, Rajan.
Of course, and I am going to hop right into my questions, Caroline. Now, you're joining the podcast today to talk about the newly launched Mackenzie U.S. Value Fund. What can you tell us about one of our latest launches?
Yeah, we're really excited to bring this strategy to market with Mackenzie. So, Putnam is a Boston-based asset manager, and this is one of our, I guess you would call it one of our flagship strategies, showcasing the talent that we have on the stock picking side, combined with a lot of the skills that we use on portfolio construction and risk management. This is a strategy that is goes back to launched in the end of 2016, but really has roots going back with the current manager to 2012 and even back into the early 2000s. And we showcase a really strong track record on the value side, and has been really successful for us in the States. So we're excited to bring it to market with Mackenzie.
Excellent, and we are excited too. I have to ask you, we're talking about value. There's more than one definition of value out there on the street. What does value mean to you and the team from an investment approach perspective?
I think there are so many definitions of value, and I think one thing that we really try to build into the process here is that for us, there's not even one definition of value. Um, the general approach we would label for our approach to value is we'd label it as relative value. And for us, that means when we look for individual stocks that have this valuation framework around them, we're looking for stocks that are trading inexpensive versus or relative to keep that term in vogue here, relative to their own history, trading inexpensively relative to their peer group, or maybe possibly the most emphasis would be on a relative inexpensive valuation based on the fundamental forward looking work that our research team is doing. That's really what we're trying to emphasize in the portfolio, which is where do we have a differentiated view on individual stocks? And we're going to try and own those individual stocks that we have the differentiated view on. And, the valuation thesis comes into play where we think we know something different, which therefore makes the stock inexpensive. So that's sort of the high level approach to value. And then when it comes to valuation methodologies or metrics or ratios that you might be applying, we are really you could start with, I guess you could say, sector specific, if not even industry specific, or maybe even as granular as the individual companies. There's a lot of different ways to measure value. Companies make money in a lot of different ways, and we want to make sure that we're not sort of beholden to one measure or one metric. So I think one of the biggest opportunities for us as active value managers is our index, our benchmark, actually only uses price to book to say what's inexpensive. And if you're watching business models as of more recent years, there are so many more intangible assets than tangibles, which makes price to book less effective. And so we would prefer to use some metric that's more context specific for how the business makes money. So price to book does work for something like financial stocks. But for industrials, for example, we might use EV to EBITDA because industrial companies tend to have very high book values, and therefore it's not as good of a measurement. So we try to think about that valuation approach more from, again, a little more granular, starting from the sector, but might even vary based on the companies and just the way again that they're making money, or the way that they're structured. We just try and find the right metric to use for that relative value approach.
Phenomenal answer, Caroline. Thank you. I was just asking for a definition, but you gave a pretty comprehensive look, and I appreciate it. So, I have a follow up question. You might just end up restating what you've already shared, or perhaps you might end up building on your prior answer. But I'm curious, how would you describe the investment philosophy behind this newly launched Mackenzie U.S. Value Fund?
Yeah, the Rajan, the value approach is definitely the start of it, but there's a lot more behind it. So there's this, relative value we believe is best suited for our capabilities on Putnam, at Putnam, which is really on that fundamental forward looking side. But what we're trying to do is we're not trying to let's say, bet on a sector relative valuation. For example, say utilities, we're going to, go overweight utilities because it's trading inexpensively versus its history relative to the tech sector or something like that. We think the market is pretty efficient at valuing sector by sector, but where there are those inefficiencies are within the individual stocks within each sector. So that's where we're really trying to add value, is on this stock by stock basis, which gets back to that, almost company specific definition of value. So we think this relative value approach is, best applied in this, company specific version, rather than thinking about it on a sector specific methodology. And then, maybe if I'll back up a little bit, I got kind of granular there, but backing up and just saying, what are investors looking for a U.S. large cap value strategy, and how can we deliver that? In our view, this is not an asset class where you're tactically investing, quarter over quarter, year over year, deciding which is the right exposure for your U.S. large cap value. It's probably more of an anchor tenant, and we think the best experience for shareholders, from that perspective, is consistent, modest outperformance year after year after year, regardless of the market environment. We're really trying to build a durable strategy that can perform no matter what sort of the externalities are. So that relative value approach is one that we think fits very well with that. But again, it's the trying to achieve this consistency, this smoother ride, and good experience for shareholders. We think that's best achieved through this relative value approach that focuses on fundamental stock picking.
These are excellent perspectives, Caroline. We're going to get into specifics. How does your team actually source ideas? You kind of alluded to this earlier, but I'm curious. Are there specific screens or metrics the team relies on?
Yeah, we unpacked a little bit about the valuation metrics that we talked about, but there's more, or maybe there's something to talk about before we get to the valuation metrics, and that's, where do ideas come from in general? So we usually say we have three buckets of ideas, or three sources of ideas, and when one thing to maybe emphasize is that we're very bottom up, so we don't start with a 3,000 stock universe and then apply lots of different layers of filters to then get to a couple hundred. Everything for us is really sort of bubbles up from the bottom up, and just sort of puts ideas on the table that we think we should be considering. So the first place to start is the benchmark, and it's funny that because what I'm going to say is that we really don't like using the benchmark in this in this step. Um, but the benchmark is there to tell us, one view, that price to book view of what is value, and but you have that first limitation of it being only price to book, and a second limitation of that the benchmark is only casted once a year. The end of every June is the reset of the Russell 1000 value, and the other whatever 11 months of the year, it's completely oblivious to what's happening in the markets. And so the markets are obviously much more dynamic than that. And so we think we want to be looking for value much more frequently, and then using different metrics than just price to book. So I'd say most of our ideas come from our fundamental research team. We have about 35 analysts that are out there sourcing ideas, know this strategy very well, know what the portfolio managers are looking for in individual stocks, valuation first and foremost, and then having a good idea of what they look for in fundamentals. So that's really where the ideas come from. That's what we're trying to emphasize in the portfolio is the analysts have a, differentiated forward-looking view. I'm gonna repeat that over and over again. So that's where we want to find most of the ideas from that source. But one additional source that we'll use, which is just to make sure we have the most robust opportunity set. We acknowledge that even our, fundamental research team that we value so highly does have flaws. The amount of or the depth that we expect the research team to be going into on each individual stock does limit them from a capacity perspective. Maybe they just don't cover some stocks and that should otherwise be looked at. There's also the element that we all have to acknowledge of just human emotional biases. Maybe you had a bad experience with a stock or a company 5 or so years ago, and you've just put it on the back burner since then. It doesn't mean that that's not worthy of consideration now. And so, to sort of solve for those shortcomings of a human practice, we have I'll call it a quantitative resource. Calling it a model is probably it makes it sound very complex. It's actually relatively simple, but it's a quantitative model that we've designed custom to the strategy to go out and look for names and stocks that it thinks are, a good match for our process. It has the ability to do this, any given any point in time as frequently as you'd like, and then also has limitless capacity. So it solves for a couple of those problems with the research team. It has no biases, obviously. So it might just help to uncover some additional ideas that maybe the research team didn't get to yet, for example. And so it just makes some suggestions as well. And importantly, I mentioned we try not to sort of make decisions based on what sectors we want to be in or not be in. The model itself sort of normalizes based on sectors, so it's not saying overweight tech, underweight, or overweight utilities, underweight tech, to get that other example. It's just saying within utilities, here are the best ideas. And from that point on, it's just making a suggestion. It's not making a full recommendation or any purchase in the portfolio, but it's making sure that we have sort of the most robust idea generation. So if we have 80 to 90% of our ideas coming from our research team, maybe that extra 10 to 20% could be identified by the quantitative model. But importantly, after this step, everything then goes through fundamental research, which is what we are really trying to emphasize.
That's great, Caroline. Now, I'm going to skip ahead and I'm going to go to a question that I am fairly certain is on the minds of many of our listeners here at home in Canada. And that is many in our audience are likely familiar with the Mackenzie US All Cap Growth Fund, which is also managed by your colleagues at Putnam. How would you contrast the two approaches to money management?
Yeah, so the maybe I'll do where are the similarities first and then we'll contrast it. So the similarities are that Putnam as an organization, our emphasis, as I mentioned at the beginning, is really on this fundamental research where I sound like a broken record, but every single one of our portfolios is trying to maximize the impact of that fundamental research where we really think we have a distinctive view, and then using very similar risk tools across the organization to make sure that those research ideas are elevated in the portfolios and that we're not making non-stock specific bets that might have some impact on the portfolios, but we really don't have the expertise to be positioning them that way. So that's the similarities, and I would say it kind of stops there. The differences, or the way I would juxtapose the two, we have two different portfolio management teams. We have Darren Yarrow and Lauren Demore, who are the named managers for the value strategy. And then on the growth strategy, it's Greg McCullough and Richard Bodsey. You're using two philosophically different approaches here. The only thing in common again is that fundamental research view. Richard and Greg on the growth side use a thematic approach to help identify long term growth opportunities. And then, contrast that with what we've already talked about on the value side, which is this fundamental bottom up portfolio looking for stocks with valuation sort of as the front runner there. So the growth approach very different from the value approach. Um, then there's the all cap label I'd also throw out there. So Richard and Greg are looking up and down the entire market capitalization spectrum, and Darren and Lauren in the value strategy are primarily going to be large cap only. So there are contrasts. There's the similarity again in the fundamentals, but I would say sort of when we think about styles, they're sort of on the opposite end of the spectrum from the U.S. equity investing as far as growth versus value, and then just some ways you're identifying the opportunities. I would say both do sort of have a quality tilt relative to their peer groups and their benchmarks, so they're kind of complementary in that way, but definitely sort of solve for different parts of the US value exposure.
That's wonderful. Now, Caroline, there's nothing like a stock example that brings an approach to investing and philosophy, and even this contrast to life. Maybe you could give us two. Perhaps first you could give us an example of a buy, and also then maybe introduce us to your sell discipline.
Yeah, so maybe on the buy, I'll actually go with something relatively recent, which was in the last month or so. We've actually made a purchase of BlackRock, the asset manager. And just to give you perspective for the U.S. large cap value, with the Russell 1000 value as a benchmark, financials are over 20% of the index. So consider that, roughly 20% of the universe is just in financials. So we're always looking for some, differentiated ideas in financials. And what we're looking at here is, okay, what's this valuation opportunity? So BlackRock historically is you would have been just considered a traditional asset manager, but they have been very active in shifting towards alternative asset management, just through a handful of different acquisitions. They now have over $600 billion in private markets and alternative assets. That really should change the approach to valuing BlackRock as a business. So you could compare it, to one of the other just more traditional asset managers from that valuation perspective, or now you have the company being much more much higher representation in alternatives, which should give you more of a shift towards an alternatives valuation. And given the higher margin of that business, higher growth rates of that business, the alternative managers do trade at a premium to the traditionals. So that's where you have sort of this valuation discrepancy when we get back to the relative value argument is relative to its peer group. Where is it trading? We would argue that BlackRock probably deserves a new peer group, and so therefore is deserving of a different valuation. So that was a name that we purchased again over the last month or so, and I think is set up for a good long term story here. And that's one thing that maybe I'd emphasize when we're thinking about names. We're looking at probably owning them for 5 years, and so what's this, business transition in this case that makes BlackRock deserving of a higher multiple? And it's this transition towards a higher margin alternatives business.
That's great on BlackRock. You had a sell idea too, I think.
On the sell side, something that we've gone through recently, we had a position in NXP Semiconductors. Their main end market is basically in autos. And so the thesis originally behind owning NXPI is the ticker, was the with this end market in autos, one of the key points of emphasis here is electric vehicles. And so there was this big opportunity to be a supplier of all the semiconductors and the chips that would be needed for electric vehicles. So a great opportunity, if you think about it over sort of again that 5 year time horizon. And then what's just happened and how things have evolved over probably the last 20 to 24 months is I think everybody kind of knows electric vehicles. Maybe it's a combination of disappointment because that has become a much more competitive universe. And then maybe the uptake on EVs isn't what we thought, particularly here in the States. So you've definitely got sort of a weaker end market than we had originally anticipated. And then specific to NXPI, one of their bigger sources of business geographically is coming from China. And so as an OEM, manufacturer for, the a Chinese end market, we all know which direction that is heading is that, China is trying to onshore most of its OEMs. And so we look at NXPI with a weakening end market and then this potential shift with a major geography as changing the story and changing that opportunity. So we exited out of NXPI in the first quarter of this year, just kind of finally saying, all right, over the 5 years, I think this story has sufficiently weakened where, it doesn't have a place in the portfolio anymore.
Great examples. Now, for my final question, Caroline, what is in your mind the important considerations for our listeners to think about when it comes to performance? How has the strategy performed across different market regimes, especially when value has lagged?
Yeah, Roger, I love that question because it all comes back to, we've designed this strategy. If you think about what my comments were in the beginning of our conversation, for consistency, and we really are trying to build something here that, regardless of the market environment, is durable and has the potential to outperform its value benchmark here. So by building this portfolio that's focused on fundamentals, but we can be very diversified across stocks, and then emphasizing portfolio construction and risk management to make sure we're not building up, exposures that have the tendency to revert in the markets. We think we can achieve that durability. So you have lots of different ways to, I guess, to evaluate that consistency target. I would throw a couple of different metrics at you here. So just maybe just to start at an annualized performance. So this, because it's kind of getting, we start simple and then get more complex here. So since inception of this strategy that Mackenzie has launched, which was 2016 here, this portfolio has outperformed the benchmark by round numbers about 5% annualized. That's through March 31st. That is a great absolute or relative achievement. We're very proud of that. But in the end, for us, what's important is more about the experience of the shareholders along our shareholders along the way. You could get that 5% excess return by, having one or two amazing years and then everything else being mediocre. Our What we're really trying to focus on is that experience for the shareholders. So if we break that down by calendar year, so this is now 8 calendar years that this version of the strategy has been running. We have outperformed the Russell 1000 value every single one of those calendar years. And those are things like, just to put into perspective, 2022, where the Russell 1000 value was down 7.5, and obviously the S&P and the growth indices were down much more than that. We outperformed by roughly 4.5% in 2022. You can back up to 2021, which was a very strong environment. The benchmark was up 25%, and we outperformed by, I think it's around 9%. So great performance, regardless of, big up markets or bigger down markets. So we're really trying to say, hey, we don't care. We think we've got something that can deliver no matter what. And then maybe two other metrics here is first on, just again, just different ways to measure this consistency is the upside and downside capture ratio. So, measuring how this portfolio does when the markets are up on a monthly basis and then versus how it does when things are down on a monthly basis. The upside capture over the last, we just do a 5 year measurement, for the portfolio has been around 109%. So when the markets are up, we're capturing, 9% more than the base, which is the index there. And then when we have down markets, we've captured 83% of the down market. So capturing more on the upside, protecting on the downside. That's a really, really powerful combination, that I think is unique in the U.S. large cap value space. Um, so those are just a couple of different ways to think about performance. But what I think I'd emphasize is, let's not just look at, that annualized excess return. Let's, try and boil it down into some different perspectives. How we done in different markets? How have we done, an up and down, or when growth and value are leading, or when tariffs are front and center, or it's just more of a normal market. We'd rather measure it that way, just to say, all right, are we, consistently delivering alpha regardless of the external market?
That's great perspective. Thank you very much, Caroline. And I'm just looking at the time. We have come to the end of our scheduled time for this episode. Really appreciate your participation in our podcast, Caroline. Had a great, wide-ranging conversation, and I'm looking forward to having you back sometime soon.
Great. Thank you so much. It was a pleasure.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.